We've been debating value versus growth for a long time, but let's talk about growth. If you want to beat the markets this year, you might want to pay close attention to our next guest, who has doubled the S&P returns in 2019. Cathie Wood's ARK Innovation ETF, that symbol is ARKK, is up 23% so far this year. The broader S&P only up 11%. Biggest holding in the ARKK, Tesla. It makes up nearly 10%. She says that stock could rally more than 1,000% over the next few years. Let's bring in Cathie Wood, CEO and CIO of ARK Investment. Do you still have a $4,000 price target on Tesla?
Yes.
This is long term, I know.
This is a 5-year time horizon. That's what all of our forecasting is. 4,000 is the bull case, 700 is the bear case. It's rare for us to have a stock that meets our minimum hurdle rate of return in the bear case. So it's north of 15% compound annual rate of return to get to our bear case target.
Give us the 20-second case for why Tesla could go to 4,000 in 5 years.
Yes. Well, first, they are scaling the electric vehicle market. We think the electric vehicle sales in 2023 will be, in total, globally, 26 million units, up from 1.3 million last year. So that's a 20-fold increase. We're talking about exponential growth, but that's not the big story for Tesla. The big story is autonomous taxi platforms. We're moving from a hardware-centric, low gross margin model, which is 25–30%, to a transportation as a service model. They'll get a piece of every ride taken because they'll own the platform that these fleet operators will be riding on. And that's more of an 80% gross margin business. Yeah. So, and that. We just did a podcast with Elon Musk 2 weeks ago. And if anyone really wants to understand what's going on in his head, we're talking about exponential growth.
Where can they hear that if they want to hear it quickly?
It's FYI Innovation. It's our podcast.
Okay.
For your innovation.
You know, Dave, Cathie's become a little bit of star in the active management field. There aren't many stars in the active management field, I should say, in the ETF business, because Cathie's willing to take outsized bets. I mean, we're dealing with what, Cathie, your top 10 or 60% of the fund, there's 10 stocks, and really it's 5. You've got Stratasys, NVIDIA, 6% weightings. I mean, you got to love somebody like Cathie that really makes a big bet on a small number of stocks.
Yeah, I mean, what you're doing is what you want out of an active manager, and frankly, what's so rare in active management, right? If I'm going to make a bet on an active manager, I don't want them owning 300 positions and giving 10 basis point positions. Right. So I think what you're doing, you know, obviously it's been working, but it's also really honest active management in the sense that you're not only showing what you own, but you're standing behind it and you're taking those big bets.
And Ben Johnson, why isn't there more Cathie Woods out there? Is it just hard? People aren't that good at active management, which is what it seems to be at this point? What's the problem? Why aren't there more Cathie Woods?
I think it's difficult. The other question, if I may, for Cathie is how you think about kind of managing the balance between sort of conviction and capacity with a very concentrated portfolio when you're operating that portfolio within an ETF. We've seen a lot of similar portfolios in the open-ended mutual fund world, know when they have enough and be able to close the fund to investors. And to a certain extent, you don't outright forfeit that ability in an ETF construct, but what would result would be a closed-end fund. So how do you think about that?
Well, the great thing about focusing on exponential growth and disruptive innovation is we should be able to grow exponentially if we are right on these 5 innovation platforms that we think each represent multi-trillion-dollar opportunities. So DNA sequencing, robotics, energy storage, deep learning, blockchain technology.
But are there some small caps that you kind of have to avoid because it's a big fund now? It's a $1 billion-plus fund. Can you really own a $50 million company in that portfolio?
There is such fear out there about volatility associated with innovation. Volatility, by the way, is a very good thing on the upside, right? There is so much fear that we get opportunities all the time to buy stocks that are destroyed, especially the small cap stocks, just because people are afraid. They're not in indexes. They dump them during a correction. We consolidate our holdings. And if we get an opportunity to buy a NanoString or an Invitae during those downturns, they earn their way up into the top 10.
And all of these are actively managed. You have
Yes.
more than just one fund.
Yes.
The ARKK, your flagship, is $1.5 billion assets under management. You have the ARK Web X.0, which obviously deals with internet and web related. You have the ARK Genomic Revolution, which is ARKJ, obviously dealing with genomic issues. Industrial Innovation ARK
Yes.
that's out there. These are all, they're all actively managed. Is that right?
Yes, and the other reason you're not seeing a lot of active managers out there in the ETF world is we have to disclose our holdings at the end of every day. We are a liquidity provider. We don't mind showing our holdings because we're usually buying stocks like Tesla when they're down, and we're usually taking profits when they're up. So in the fourth quarter, Tesla screamed while Nvidia crashed.
Very quickly, before we move on, how do you change your position? I mean, will you announce at any one time, I'm going to go from a 9% weighting in Tesla to 6%? How does this process happen? You don't, most of them rebalance on a quarterly basis, for example, if you're equal weighted. How do you rebalance, or what do you?
We trade every day. I'm not doing anything different now than I did when I was managing mutual funds, separately managed accounts, and we do manage those as well at ARK. It's the same. We're wrapper agnostic. There's
so
no
if you
difference
decide to sell
whatsoever.
Tesla, we'll just find out when we look tomorrow and Tesla's not in the portfolio.
Well, actually, we post our trades once we've completed them. And the reason for that is market makers were so uncomfortable with this idea of an active manager. They felt they'd be caught flat-footed, that we said, fine, we'll post our trades once we've completed them so that we're both on the right side of this thing.
Well, the proof is in the pudding. So far, you've been outperforming, and it's very tough to get active management outperformance, so kudos to you.